Okay guys, g'day and thanks for listening to another YouTube lesson. Now, always business studies is full of fun, but get yourself strapped in and ready for this roller coaster of enjoyment you're going to look at today. We're looking at forecasting, yes, and we're looking at total revenue, total cost, break-even analysis, and cash flow projections. Sounds like fun. What's forecasting? Forecasting means or refers to trying to predict what will happen in the future to help towards planning for the business for future events. Now, some examples of predictions include projections for sales, output, expenses, growth of the business, or market share. Now, there's some different types of forecasting tools that can be used. They include break-even analysis and cash flow projections. An example of this forecasting could be if an owner may need to forecast the availability of labour or raw materials, finance, building requirements, okay, then they would be able to use this to look ahead to see what type of labour they need or how much will the raw materials and so cost. Now, business will often want to forecast its potential, its projected total revenue or total sales. It'll often want to look at its total costs. It'll try and look ahead to when the total costs, are equal to the business's total revenue. If total costs equal total revenue or total revenue equals total cost, then at that point, that quantity of something being sold, we call it breaking even. All right, and this is what break-even analysis is about, finding where total revenue is equal to total cost. Now, total revenue. Business will want to put in their business plan the predicted forecast for total revenue. This is simply the total number of predicted sales times the price at which the product was sold for. Give you an example. If there were 1,000 items of something being sold, 1,000 computers, for some reason computers cost $2, then the predicted total revenue would be $2,000. Now, it's very difficult to predict total revenue when a business is just establishing itself, as there is nothing for it to use as a base point. But like everything, you have to do your best when you're starting out to predict and plan. Look at what similar businesses around you are getting in revenue to give you a chance of figuring out what you might be likely to have as your revenue target. Total cost. That's another key part of break-even analysis. Likewise, businesses will want to put in their business plan the predicted or forecast total cost. Total costs are made up of two different aspects. You've got your fixed costs and you've got your variable costs. Often on graphs you see FC for fixed cost and VC for your variable cost. Some examples of fixed costs include rent and machinery. These are things that are the same cost generally, whether you make 1 unit of something or 1,000 units of something. That cost stays the same. You buy one factory, whether you make 1 car or whether you make 1,000 cars, you still just need the one factory. That's a fixed cost. These are pretty easy to predict because once you kind of know what fixed costs you're going to need, it stays the same, whether, again, you make 1 good or 1,000. Variable costs are a bit more tricky. Some variable costs can include wages and the cost of purchasing raw materials. The more cars that you manufacture, the more computers that you make, the more shirts that you make, well, your variable cost will go up because you're requiring more raw materials in the cotton, finest silk in town, or more plastic and metal to make the laptop and so on. Now, break-even analysis. It's not a term you've heard a lot about, but something you do definitely need to know. Could be a question in upcoming exams, so please listen carefully. Break-even analysis or break even occurs when the revenue, total revenue received from the business's sales is equal to the total cost. That's the fixed cost and those variable costs. Now at this point, no profit is being made, but no loss is being incurred. So the formula for break even is break even equals fixed costs divided by, your brackets, price per unit minus variable costs. You'll see that in your notes that I've given you in your booklets. I'll say it again because quite often you'll have a multiple choice question and you'll need to figure out the break even, i.e. how many items or units of something do you need to make for a particular business to break even. Is it 10 computers, 100 computers, or you need 1 million computers to break even? So the formula again, to break even, you need to make sure you have your break even equals your fixed cost, and that'll be provided, divided by brackets, your price per unit, so maybe $2 per unit, minus your variable costs. Close your brackets. Now break-even analysis involves looking at what the level of sales would need to be in terms of a business's total revenue, or where a business's total revenue will be equal to its total costs. It's a very useful tool. It will allow a business, a new business, to set its first major goal. It sounds like a crappy goal, but its first major goal is to stop losing money. Not about profit yet, to break even. That's a key goal. Once you can break even, generally we'll get better from there. Now, the last thing we're going to take a look at today is cash flow projections. It's exactly the same as a cash flow statement, but with one major exception, a projection part. With a cash flow statement, this is a reflection of what has actually occurred. What's happening with your bank account, your money in and your money out of your bank account. Whereas with a cash flow projection, as it states, not surprisingly, you're looking at a prediction of the probable or possible cash flow. You're trying to predict what your likely cash flow will be. Now it provides information concerning the business's expected cash receipts, the likely projected cash inflows, and the potential or likely cash payments, those cash outflows going out of your bank over an accounting period, usually 12 months. Now, cash flow plans consist of month-by-month projections of the flow of money in and out of the business, and often we see it in the HSC from January all the way through to December. All right, cash transactions can include cash sales, or the collection of debts and the payments the business expects to make. All right, now, all of these things are key aspects of forecasting. Just to recap again, we're taking a look at, in terms of forecasting for a business, what is the likely total revenue? What's the likely total cost? When your total revenue equals your total cost, then you have that break even. And another key feature of forecasting is to look at those cash flow projections. All right, guys, thanks for listening and see you next time.